The stronger than expected US growth number fueled the soft landing bets for the US economy yesterday and pushed the S&P 500 to a fresh record, but that optimism could rapidly fade away with the sight of a hotter than expected inflation print before the closing bell in the US today, or not. So welcome to Swissquote's daily market talk and happy Good Friday. So the news from the US yesterday were again surprisingly good. Have you seen them? Because the US printed a better than expected growth of 3.4% last quarter. Sales grew more than expected. The GDP price index fell, but it fell, well, somehow slower than expected to 1.7%. Corporate profits jumped nearly 4% in the third quarter of last year. That was versus less than 1% printed a quarter earlier, and consumer sentiment jumped to the highest level since mid-2021. Of course it did. I mean, the economic data could hardly be better than this. Well, the stock markets in the US could hardly perform better than this as well. And, well, the Federal Reserve could hardly be more dovish than this, given the strength of the economic data in the US. Even though obviously the set of data that was released yesterday in the US was again a warning that the Federal Reserve is not in a rush to cut its interest rates to save the US economy, because the US economy doesn't need the Federal Reserve's help to be saved. So this is also the message that the Federal Reserve's Christopher Waller conveyed earlier this week. The man just stated the obvious as he said that the recent economic data in the US deserves delaying the interest rate cuts and maybe also reducing the number of them moving forward, and that he actually wants to see at least a couple of months of better inflation data before easing policy. But this is obviously not what the majority of Fed members think right now. They actually think, on the contrary, that 3 rate cuts from the Fed this year would be suitable in the actual conditions. So yesterday's better than expected GDP pill in the US went down, quite smoothly down the market's throat, as Waller's hawkish remarks were obviously very rapidly washed away by the soft landing bets and the soft landing dream, and bets that the Federal Reserve will in all cases cut the interest rates into the summer if it doesn't want to take the center stage in this US political turmoil into the November's presidential election. So if inflation data in the US doesn't get meaningfully ugly, the rate cut should arrive by June or by July. And on this belief, we saw the S&P 500 gain after a strong GDP data yesterday. The index advanced to a fresh record, while Nasdaq, on the other hand, closed the session slightly lower than where it started. The US dollar index extended gains and the euro dollar fell to 107.75 level, turning the medium-term outlook from bullish to neutral, while cable remained offered nearest 100-day moving average yesterday, as this week's numbers confirmed that the UK ended last year in a recession. Yes, the contraction in the second half of last year was very slightly smaller than expected, but the economic troubles in the UK and obviously the cost of living crisis that the households are undergoing were quite real. So the data backed the dovish Bank of England expectations and should keep the sterling offered into the 100-day moving average near the 126.55 level against a broadly stronger US dollar, as the US dollar bulls defy the dovish Fed expectations faced with economic data which kind of looks unideal for interest rate cuts. And speaking of rate cuts and debates about who will cut and who will not, among G7 currencies, the Australian dollar actually stands out as a potential winner of the upcoming interest rate cut cycle from the major central banks, as the RBA is expected to maintain its hawkish stance for the most part of this year due to inflation risk. Now, data that was released this week in Australia show that inflation in Australia remained unchanged at 3.4% level in February. So that was, well, versus an uptick to 3.5% expected by analysts. But the core measure rose from 3.8 to 3.9%, and services inflation in Australia rose from 3.7 to 4.2%. So those are not the levels that will make the RBA comfortable with an early rate cut in Australia. So while it's difficult to say that the Aussie will or could perform well against the US dollar, well, a further Euro-Aussie weakness could actually be well justified by this divergence that's happening right now between the European Central Bank and the RBA policies, ECB being more dovish than RBA. Now, today, most exchanges around the developed world will be closed due to Good Friday holiday, but the US will still print its latest core PCE figure today, which is, well, the Federal Reserve's favorite gauge of inflation, as you know. And, well, a hotter than expected inflation report from the US today could further back the US dollar bulls, and they could maybe, but just maybe, also temper the dovish Federal Reserve expectations into the second quarter, because a good growth number is good news as long as inflation remains low. So if inflation shows signs of picking up positive momentum, it suddenly becomes bad news. So we will see what the economic data tells us, but some bank analysts, and I'm referring to a UBS report that I read this morning here, well, they think that inflation in the US will finally trend lower thanks to lower rents, moderating signs of growth, and cooling labor market. They actually highlight the downside pressure on Atlanta Fed's GDP now index that predicts around 2% growth in the first half of this year. But even a 2.1% growth, well, the US economy will be growing at an above average speed. So the Fed opinions obviously diverge a lot and will continue to diverge greatly as we enter the second quarter of this year, because obviously strong growth, robust corporate earnings, solid investor sentiment, solid consumer sentiment, and stock markets running from record to record, well, don't necessarily call for a Fed cut anytime soon. But for now, the base case scenario is still 3 interest rate cuts in the US this year, with the first rate cut seen in June with around 64% probability attached to it, unchanged after the GDP update yesterday, and that's obviously supportive of further gains in the stock markets. But as we have been discussing earlier, well, this week, the nature of the gains in the stock markets could actually change, as we could see some reflation trade happening and favoring value stocks over growth stocks moving forward. Even though the US markets gave no signs of the technology rally broadening to other sectors in the first quarter of this year, the reflation trade benefited to good quality European stocks, for example. And in this context, the Stoxx 600 finished the first quarter at a record. Defense stocks especially were the biggest gainers, well, of this quarter since the war in Ukraine started, because look, the German ammunition and tank gun maker Rheinmetall rose nearly 600% since the war started in Ukraine, and well, this prolonged period of war on the old continent also leads the European nations like Germany and even Switzerland to increase their defense budgets, though roughly something that we haven't seen in a long time, and that obviously should continue to back further gains in the defense industry moving forward. On the other end of the spectrum, mining stocks were the worst performance of the first quarter in Europe. Subdued iron ore prices due to these Chinese property troubles, while kept Rio Tinto, for example, under a decent selling pressure for most of this quarter, as well company makes half of its revenue from iron ore. Energy companies, on the other hand, had a good quarter in the first quarter, as crude oil remained on a sustainable positive track since the year started. The French Total Energies, for example, closes this quarter near a record level. American crude, on the other hand, jumped past the $83.50 per barrel level yesterday on the back of, well, strong economic data from the US and dovish central bank expectations. So the bulls have their eyes still set on the $85 per barrel target, while natural gas bulls are still nowhere to be found into the second quarter of this year. So this is all for this week. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, have a lovely weekend and happy Easter.